Gentlemen, thank you, and I welcome you all in this interactive and knowledgeable webinar and panel discussion today. My name is Kundan Javeri, and I'm a part of the business development team in the National Stock Exchange. I would like to take this opportunity to request Mr. Ravi Varanasi to say a few words and welcome one and all. Mr. Ravi Varanasi is the Chief Business Development Officer at the NSE and spearheads exchange initiatives in the areas of market structure, policy, and business development across all asset classes traded on the exchange. He also oversees capital raising platforms for main SME and startup boards, education, skilling, and financial inclusion too. He earlier headed regulatory function of the exchange. Ravi sir represents the exchange in various committees, advisory groups of the regulatory and Ministry of Finance. Ravi sir has been with the exchange since 1995 and has wide-ranging experience in business development, regulatory, and operational roles. Ravi sir, the floor is all yours.
Thanks, Kundan. Mr. Chandrasekhar, Mr. Ajay KEDIA, Mr. Amarendra Mishra, Mr. Sandeep Bajoria, Mr. Ravindra Rao, Mr. Atul Chaturvedi, Mr. Sudhakar Desai, ladies and gentlemen. Good evening, everybody. I extend a warm welcome to all of you to this topical webinar on price risk management in Indian edible oil industry. I'm happy that we could bring together a galaxy of stalwarts from edible oil industry fraternity who could discuss the topic and provide deep insights on how to manage risk in this area. As you all would be aware, NSE is the largest derivatives exchange in the world and third largest equities exchange. We offer trading facilities across multiple asset classes under one roof. Equities, equity derivatives, fixed income derivatives, currency derivatives, interest rate derivatives, you name it, all kinds of products are available. Subsequent to SEBI's guidance on universal exchanges, NSE also launched a commodity derivatives platform in October 2018. NSE is focused on bringing about continuous innovations in products, technology, and processes that would enable ecosystem to derive maximum benefit. In commodity space, though we are not very old, we're just about a couple of years, we started off by offering futures contracts on bullion, gold and silver. Thereafter, we've added other products slowly. We've gone to Brent crude, then we've brought in gold mini options, copper futures, etc. Last week, we have introduced a 1 gram gold product. Again, we are seeing a significant amount of traction in that product. We try to bring in innovation into the commodity space from the time we started our efforts in this area. Before NSE, the gold, there was standard was only LBMA, London Bullion Merchants Association's standard. So we have kind of went through a series of processes and we have empaneled Indian refiners and went through a series of vetting process so that Indian refiners who meet our standards, which are BIS standards, they are allowed to kind of deliver their gold on NSE now. So this has started. This is for the first time when we started our product. We have decided that we should get Indian refiners to deliver their gold. Idea is to try and expand the local refining of gold and the recycling of gold, which could finally help the economy as a whole. Our first agricultural product obviously was degummed soya oil product, which we have introduced in December 2020. We are seeing a reasonable amount of traction in the product. Coming to today's discussion, I'm no expert on edible oils. However, as we all know, edible oils are an indispensable part of any Indian kitchen. While India is seen as a major exporter in quite a few agricultural commodities, when it comes to edible oils, more than half of total demand for edible oils is being imported. We all know that crude degummed oil is the second largest produced vegetable oil in the world. Soya is also the second most consumed edible oil in India. CDSO holds almost 25% of the total imported vegetable oils into our country. Globally, the largest exporters are Argentina, Brazil, USA, we obviously are one of the largest importers along with China and Bangladesh. The degums oil, since it is imported, the price is dependent on international, kind of prices in originating countries. Since there is a fair amount of volatility, the volatility does get transmitted. As you're aware, soybean and refined soya oil contracts are already available on CDEX. To complete the soya complex, we decided that we should bring in a CDSO contract. And when we went around and then spoke to the industry, the feedback was that we should go with this cash settled product. That's how we have introduced this product. We are again soya oil prices are dependent on international price movements, and as we see, the market is reasonably large for degummed soya oil, close to about 25 to 30,000 crore rupees per year. There is volatility, particularly in view of the happenings in the world. And we believed that CDSO futures contract will kind of bridge the gap and then allow Indian participants to kind of hedge their positions within India. So that's where we have introduced this contract. The contract is a 10 metric ton contract, ex Kandla price, and then it kind of captures the imported CDSO price. So we have seen a reasonable amount of volatility in the last 2 to 3 quarters, and that could possibly leave a lot of players to looking for hedging opportunities. That's where we think CDSO contract on our exchange would really fill in the gap and allow the participants to manage their exposure. Since NSE also offers series of other products like currency derivatives and all, some of the importers and exporters can actually lay up their residual risk on the NSE platform. That's additional convenience.
Ravi sir, you're on mute mode. You're on mute, sir.
It went into mute now?
Yes. Just 3 seconds ago.
Oh, okay. So as I said, we have a detailed presentation on hedging avenues as well as a fantastic panel which will actually discuss in depth and possibly bring you insights that will help you navigate your hedging requirements in edible oils area. I really don't want to take too much of time. Thank you all for joining us. Stay safe. Over to you, Kundan.
Thank you very much for your kind words, Ravi sir. We are privileged to have you here. I would now invite my colleague Jay Shah to present his piece. Jay is a part of the business development team at our Ahmedabad regional office and would be giving a brief on our CDSO futures contract. Jay, over to you.
Thank you, Kundan. Thank you, Ravi sir. I hope my voice is audible.
Yes, you are.
Okay. So I'll get you through the NSE crude degummed soybean oil futures. So the contract was launched on 1st December 2020, and since that it has gained some traction. So the contract mainly just will get you through the contract specification. If you can follow my cursor. So the contract is based out from Kandla. The quotations are rupees per 10 kg. Trading and delivery unit is 10 metric ton. Tick size is 10 paisa. The quotation of the contract is X tank Kandla, inclusive of all duties and exclusive of GST. The contract will be available for every month, so serially monthly contract. So the expiry date of the contract will be the last working day of the month. So it is very much in correlation to your month end forwards or your currency futures, right? The trading session is 9 a.m. to 9 p.m. Monday to Friday. The last trading day is last calendar day of the contract expiry month. So the aggregate position limit for the member and client is given in the slide. The aggregate position for member is aggregate total for near next for all the months. It is 4,56,800 metric ton and client is 45,680 metric ton. Now the best part of the settlement. Settlement is cash settled. Cash settled, it will be the contract will be cash settled based on the final settlement price average of last 3 days evening spot. So we have a spot coming at 12 and 4:30. So if you average out last 3 days evening spot, the contract will be settled on that price. So this was the brief about the contract specification. Now you can also refer this circular NSE COM 46294. This is a circular where all the details of the product can be found. Now I'll get you through the market making. Like everybody, since it is a new contract, everybody is wondering like whether there will be the liquidity in the contract, whether we will have the exit entry in the contract or not. So I'll just let you through the market making that is there in NSE commodity segment. The market making scheme is aimed with providing the continuous quotes to be available in near and next month. Both the near and next month, you will have a continuous quotes. So it makes the contract highly liquid. The entry and exits are very easy. There will be two market makers, primary and secondary. Both market makers will provide continuous two-way quotes. They need to provide at least 85% of the time. The quotes are to be provided in top 5 lines with defined quantity and bid ask. So what are the bid ask quantity? So on the top line, the primary market has to provide the bid and ask with 4 ticks difference. That is a 40 paisa difference for the near month. And the next month, he has to provide 5 ticks for the next month. The top line quantity, he has to provide 20 metric tons. That is 2 lots for near month and 1 lot for next month. So and the same for the secondary market mine. So if you combine both of the market makers total book, so at any point of time you will have 24 lots on the buy side and 24 lots on the sell side. So that is a 240 MT on the buy side, 240 MT on the sell side. So there is a penalty provision for the market maker to meet if they don't meet the obligations. So why I'm saying this? It is like as a market participant, anybody is worried about whether they will have a proper liquidity, whether they will have a quotes. So to facilitate this, we have come out with this market making thing. Now the reference circulars are 46355 and 48274. Now going to, I'll just let you through the contract performance. So the contract, as I said, was launched in the month of December. So since December, if you can see the blue bars, it has the volume bars. The orange line is the OI, and the gray line is the overall the turnover. So if you see, we have seen the highest volume on the 24th December 2020. It was around 12,950 ton. MT, and highest OI was on the 26th April 1500 MT, and the highest turnover was again recorded on 24th December 2020. That was 142 crore. That is ADTV. So month wise, if you can follow my cursor, these are the average volume, average OI, and average turnover. So December, January, February, March, April, May, June. So this is how the contract has performed over the last 6 months. So with this, I would like to end my presentation. For any queries, you can contact NSE on the email ID, that is nsccommodities@nsc.co.in. Kundan, over to you.
Thank you, Jay, to give a detailed product description. I would now request and call upon Mr. Ajay KEDIA to please enlighten us with the concepts of hedging in the Indian edible oil industry. Mr. KEDIA, the floor is all yours.
Thank you, Kundan. Good evening, everyone. Please just let me can share my PPT. Okay, thank you. Kundan, my screen is visible and my voice is clear.
Yes, your voice is absolutely clear.
Thank you. Thank you. Good evening, everyone. So, first of all, thank you very much for inviting me for this session. Today's session will be price risk management and in Indian edible oil industry. We have already seen in last 3 to 4 months whatever the price move is going on. It's tremendous. We have never seen in a decade or past also. Today we have a very good series of eminent panelists. Let's start with the price. What is hedging and why we should take for hedging? So hedging and price risk management is nothing new. Everyone knows it, but there are some critical points which are lagging with us because of that. We have seen Indian market has been facing a constraint in hedging. So today's session would be in a 5-pointer. First, we will be seeing the hedging. Then we'll see how global corporates are hedging. Then volatility is most important because already in last 1 week, 1 year period, we have seen the huge volatility in every agri commodity. In fact, in edible prices, we have seen there is consistent volatility since last 2-3 months because of n number of events that have been happening in international market and domestic market. Then we'll see a raw material and what is the relation with profit, because nowadays what is happening, if your raw material prices are let's say increasing, immediately your profit part would be decreasing, that everyone knows. And then we'll see the role of exchanges and product in hedging. So let's start with first hedging. Everybody knows that hedging means just transferring the risk, whether you are taking a strategy in your equity portfolio or in home or in businesses. Important is to have a valid strategy that can help you to get out from the uncertainty. Besides protecting an investor from the various type of risk, it is believed that hedging makes a market run more efficiently. We have already seen global exchanges are having a good policies, or we can say hedgers are quite much active in international market. The best example of hedging is an insurance policy. Initially, what happened? I have almost done a survey of more than hundreds of companies and asked what is the common reason for not hedging. First is the expensiveness of platform. Secondly, availability of product and platform. So first of all, if we talk about the expenses, it's just like taking an insurance policy. First year when we pay the premium, we say it is expensive. Second year when we pay the premium, we say costlier affair. Third year, same view, very expensive. Fourth year, I should stop. I am very much healthy. But whenever there is any thing strike like COVID-19 we have seen last year, immediately there will be a high level of claims, and then we realize that mediclaim is very cheaper. So similarly, when we talk about hedging, hedging is not that I have done one transaction, I have got a profit or I have got a loss. It is a culture that we have to create in our environment. So it is most important that don't look for the price are going up or price are going down. Just hedge is most important, because whenever there are two scenarios. One scenario is when the prices are continuously rising, that you won't find that I should hedge, because whenever you buy at 200 rupees, let's say, add a cost, add a profit of 20 and sell at 240 or 250, let's say. Next batch, when you buy at 250, add your cost, add your profit, and you sell at 290. So this way we have already seen in every oil, let it be refined soya oil, digam oil, or palm oil. We have seen this type of move was been continuously in last 6 months, but now this is very high time when prices are almost tested 1400 level, and we know if suppose we have stuck with any inventories at this level, and let's say things have been cooling down slowly and steadily, then it will be a very hectic for us, because transferring the price would not be possible. So it's very much important. This is the time we should look for a hedge. Take an example. I have given two example that somebody has bought some quantity of digam oil at 1390, but he is not hedged. And suppose prices drop down in the month of July or August, then he will be facing a loss of 50 rupees. But in case somebody has his position, so if suppose spot prices are came down by 50 points, immediately he can see future market is also down by 50 points. In this way, at least he can hedge. So whenever we want to hedge, please look it. You don't have to look for the pricing, that whether price is going to be on a higher side or prices is going to be on lower side. Just you have to hedge. You have bought, immediately hedge on future exchange, so that whenever there is a rise or fall in the price, your PNL won't be impacting. So it's most important that cost is also very negligible if you cultivate the culture of hedging in your side. Second most important query we have faced, that products are not available in the exchanges, or let's say if platforms are not available. See, introduction of crude CDSO would be most important in all edible oil. We have run up with 1 year, 3 year data showing the correlation. We have found that CDSO is having a good correlation with all type of oil, like it could be palm oil with 96% of correlation, refined soy oil with 100%, let's say castor oil or cottonseed oil wash, groundnut oil, sunflower oil, rice bran oil. Every commodity has been having a correlation with low to low is sunflower oil with 86%, and high to high as a refined soy oil or rice bran oil, which is around 98 to 100%. So there will be a opportunity in market to hedge, but just you have to find. Most of the people when we talk about let's say groundnut oil people, so they say that exchange don't have any product for groundnut oil, so where we should hedge. But there is a method we call as synthetic hedging, or we can say artificial hedging. This can be developed looking to your product and your need. And you, as we know that CDSO is one of the common or crude form of oil that can have a very good correlation. So in this way, we can help you out, or exchange can help you out to find the good correlation with your available product. And last one will be the exchange. So already we have seen Indian regulator has enabled the perfect environment. We have exchanges, we have product. Now it's need is requirement is to participate, because most of the time when we talk about any corporate or any SME, they just give a excuse that there is no volume on exchanges. But see, without corporates coming on exchange, there won't be any volume also. So it's just like a chicken and egg, who came first. But I would request that don't hesitate. At least start with a smaller quantity. That will definitely green up our environment, and it will be win-win situation for exchange, for hedgers, for speculator, and for company owners also. It's a very good time, because as we know that prices are on multi-year high, and if there is any statement coming in from the international market or any factors, prices can definitely can come down to. Rather than speculating on the prices, one should hedge their position. And most of the time when we talk to anybody that so why don't you hedge? So they will tell, yes, we know that prices are right now is going up. We'll definitely look it in when to hedge. But frankly, in case of insurance also, we used to ask our client when is the right time to buy a life insurance policy. Life insurance policy is a day before you die. So similar kind of condition is with us in hedging also. Don't wait to market is about to fall. Just take a culture to hedge your positions, you hedge your inventories. That will definitely safeguard you. If you are not hedging, you are actually speculating. So please make sure that you should have a hedging culture in your offices. And there are saying that there are no risk in hedging, but much risk for companies that don't hedge. Companies must understand the price risk. They should build a hedging culture in their offices. Hedging can help to protect gross margin. Hedging helps protect to cost of goods sold. You can lock it. You can lock in your prices in advance also. Good candidates for hedging right now is a mid-sized company, because bigger companies are definitely very cash rich, so they can absorb this type of price movement sometimes. But this is the unique we have seen uh, in last 1 year. Whatever the price volatility or price movement we have seen is a unique one that has been impacting the larger company also, mid-sized company also. If the cost of if any company is having a bigger cost component as a commodity, please use every tools to de-risk this price in order to make a price stability. Hedging is like a good insurance. It also helps the company to be a more thoughtful about their exposures and to determine the strategy to reduce that risk. Now we'll see what is the scenario in global market and domestic market. In global market, we have already seen companies like AB InBev, Mars, Kellogg's have been hedging their products since Mars is hedging cocoa since 1960. Similarly, Kellogg's or AB InBev are been hedging their barley product or any other agriculture commodity since last 8 to 10 years. We have already seen in 2007-8 the crisis for food crisis has been seen, and after that there was a sharp rise in all agri commodity. And companies then they realized that we should hedge our position. Similar kind of movement we have seen this time, because whenever there is a pandemic in market, definitely the food inflation is going to be high, and this is the time we should look for a hedging. Similarly, we have seen in Indian market also corporates like Hindustan Unilever, the extracts has been taken from the public platform. You can see in the annual statement of 1920, they have clearly mentioned that they have 10% rise in the price on open trade in 1920 would lead to gain of 21 crore and vice versa. Similarly, Tata Consumer has also has their inventories for coffee, Adani Enterprises, and Titan was the very good case, because last year we have seen when the gold prices went up to 56,000. At that time, some of the investor has wrote the letter to company that despite of sharp rise in gold prices, company is not showing a good profit. That company has given a statement that Titan has given a statement on public domain that there is a no negative or positive impact on their PNL, as they are having a 100% hedge policy. So this type of things already been observed in the Indian market also and global market also. This is the time we have to see. Important is the volatility, because generally we have seen many companies goes with a currency hedging, whereby we have already seen that currency volatility is lies between let's say 1 to 1.5%. But in case of any agri commodity, take example of this red line which shows Digam oil. So Digam oil has already been seen that at some point of time the volatility is rising up to 15% also, plus or minus. So this is the time that we have to look for agriculture commodity also, because already we are hedging currency, but it's most important because agriculture is a most part of our cost as a raw material. So looking to this volatility, one should look for the hedging in commodity also. Then coming on the operating profit margin, which is lies between 15 to 20%. This is a slide we have taken from 2012. At that time, the profit margin was between 15 to 20%. But now, as we know, that profit margin are thinning day by day. And it's very much important that to look after the price movement, because whenever there is a 10% jump in any raw material prices, it can double your profit companies earning or wipe out them. So it's most important that you have to look like your raw material prices should be stable. Don't go with a hedging, don't go with a speculating the prices that prices will come down or prices will go up. Hedging will help you out to fix your raw material cost, and because any company profit is the profit getting from operational, not from the speculation of the price move. It's most important to fix your raw material cost, and hedging is the tool where we can fix our raw material cost. Now we'll see the exchange role, because already we know that exchange regulator has given a very good platforms in face of exchanges, where we can have a transparent price mechanism, standard quality, and trading size facility of hedging, assuring the participant to have a buyer at the market or a seller at the market. Then almost we have seen regulated market has been sound environments, strong systems, settlement guarantee, and technology advance. Everything is being in place. But coming on the strategy side, we can use futures and options also. Right now on CDSO, we have future, where you can have a number of strategies like procurement, managing your commodity risk with the help of future market, where procurement you can plan out, or we can hedge our inventories. There is a risk of substitute also. There is a risk of falling prices, although that can be easily hedged on futures. You can plan your procurement if suppose any other commodities have been there, or inventory prices is most important at this moment. So key takeaway for today's session would be hedging is good as buying an insurance policy. You pay timely premium to cover yourself, but when calamity strikes, it is most important, because already we have seen last year whoever paid a mediclaim, they have got a very peace of mind during this COVID also. Participation in future and options for hedging is a need of our, because we don't have any other option to hedge, because in international, if you are going, you are hedging currency also, but if you are hedging on domestic market, then definitely it would be helping your cost also. Global firms, already we have named some companies are been already using their derivative contract to hedge their physical commodity exposure, and even in India we have seen many company has already started. But this is a time we have to look for the volatility what we have seen in agri commodity in last 1.5 years, and it is very much important that raw material cost should be fixed. If it is moving very rapidly, that can impact on your profit margin, and as we know that profit margins are very thin right now, so it's most important that your raw material cost should be fixed. And exchanges has played a very huge role. Regulator has played a very good role in promoting the hedging practice in the industry. It's very much important from your side to participate in this hedging via exchanges. Don't look for that right now volumes are low or OI is low, because if you start participating with a smaller quantity also, then definitely it will be a win-win situation for all of us to get back a good platform where we can hedge our position. So with this, I end my session. Important takeaway is hedging. We should start. We should not wait when the prices will come down or when the prices will go up. We'll plan up the things. You should start immediately for hedging. Over to Kundan.
Thanks a ton, Mr. KEDIA, for the wonderful presentation and insights on hedging. I would now like to take this opportunity in giving a small introduction of all our honorable panelists, our esteemed panelists, our honorable moderator. It's Mr. G. Chandrasekhar, our moderator for this panel discussion. And I'm sure he does not require any introduction, as the nation has been listening to him since the last almost 25 years now. GC sir is an economist, senior editor, and policy commentator, and a specialist in agribusiness and commodities market. Through his columns in the Hindu Business Line, the television appearances, and personal interaction with policymakers, he provides policy inputs for the government. He speaks regularly at global forums on a range of topics, which I think the list is never ending. GC sir is an independent member, SEBI Commodity Derivatives Advisory Committee, that is the SEBI CDAC, and SEBI Research Advisory Committee as well. I'm sure you have listened to our guest speaker, Mr. Ajay KEDIA, who's given a fantastic presentation on hedging right now. Mr. KEDIA is actually the founder and director of KEDIA Advisory Private Limited, a SEBI registered research firm. And with an experience of more than 18 years in the commodities market, Mr. KEDIA is known for his research work and experts' opinion on the country's prominent business news channels like Z Business, CNBC Awaaz, ET Now, and etc. His extensive research work and regular contribution to the commodities market has been awarded by the NCDEX and MCX as the best commodity advisor. Our next panelist, our first panelist, that is Mr. Atul Chaturvedi. He's a veteran in the vegetable oil and oil seeds and agro business of the country. He has more than 4 decades of successful and varied general and strategic management experience in the field of marketing, in the manufacturing, trading, and agri-infrastructure development. He has been associated with the Adani Group since 1998 and is currently Executive Chairman of Renuka Sugars Limited as well as Director of Adani Wilmar. Mr. Chaturvedi is the President of Solvent Extractors Association of India, that is the SEA, which is a very leading trade body of the vegetable oil industry. Our next panelist, Mr. Amrendra Mishra, is currently the Managing Director, Oil Seeds and Country Manager, India at ADM Agro Industries India Private Limited. He has been working with ADM for more than a decade now. He has held several roles, including trading, risk management, and commercial management in India and United States. He has an experience of more than 15 years in agribusiness field and has worked with companies like Nafed and DCM Shriram before joining ADM. Well, I wonder if our next panelists need any introduction at all. It's Mr. Sandeep Bajoria, the CEO of Sunwin Group, and also the chairman for All India Cottonseed Crushers Association and Global Organizing Committee. Mr. Bajoria was also the past president for CEA and COOIT. Mr. Bajoria has been a veteran in the edible complex and other agri-commodity space for decades now. Sandeep sir has been a mentor to thousands while widely traveling across the globe and spreading his experience all over. He has received many awards, recognitions over the years for his contribution to the oil industry. Our next panelist, Mr. Ravindra Rao, is a CMT and is the VP and head of Kotak Research of Commodity Research at Kotak Securities and carries over 15 years of experience in commodity trading, research, and strategy. Mr. Rao is an experienced finance and management professional with proven skills in advising clients, market analysis, technical analysis. Mr. Rao has been a regular speaker on commodities for CNBC Awaaz, Z Business, and other channels. He is quoted widely in Indian press and online portals like Money Control, ET, and other media channels. Let me introduce Mr. Sudhakar Desai as our next panelist. Mr. Desai is the president of IVPA, that is the Indian Vegetable Oil Producers Association, and the CEO of Imami Agrotech. Mr. Desai has more than 30 years of industry experience. Prior to joining Imami Agrotech as the CEO, Mr. Desai was with Bunge India Private Limited as Director, Vice President. He is also associated with the Associated Chambers of Commerce and Industry of India. Mr. Desai is the chairman for Agro and Food Processing Council Eastern Zone and member of CII Food Processing Council Eastern Zone 2. So, Chandrasekhar sir, may I please request you to take over from here for the panel discussion? Thank you.
All right. Thank you, Kundan. On behalf of all the panelists and on my own behalf, let me thank you for this wonderful introduction. I'm honored, I'm humbled. Thanks for this. I'm particularly honored to have been asked to moderate this elite panel. This panel is the real elite one, and I don't think it's going to be easy for anyone to assemble these panelists on one platform. Congratulations to NSE for organizing this. Without much ado, let us get into the topic right away. First of all of us know very clearly that our domestic production of vegetable oil in relation to consumption is only 1/3, and our imports, very broadly, are about 2/3. Very surprisingly, even in soybean oil, our domestic production is 1/3 and imports are about 2/3. I think this is, I don't know if it's by design or by coincidence, but this is a matter of reality. And therefore, because Indian market is integrated with the global market, stakeholders in the vegetable oil space, whether he is a solvent extraction plant, or whether he's a standalone refiner, or he's even a financial investor, whoever, I think they will need to have a 360-degree view. This is extremely important. And for crushers, I believe the price risk actually starts at the moment the bean is converted into oil. Then their oil prices, I'm talking about only price risk in relation to oil, starts once the bean is converted into oil. What about standalone refiners? Once that crude oil is received in their factory, in the tank farm, their oil risk actually starts. And for importers, in fact, the risk starts even earlier. When the cargo is loaded in the load port of the country of origin, it takes obviously from Argentina not less than 30 days for the vessel to come here. I think the risk starts even at that point of time. And for financial investors, the risk starts as soon as their exposure crystallizes, whether it's a buy position or a sell position. And then therefore, there is risk for everyone and all the time, which is, we need to recognize that there is price risk all the time. Now, I was looking at the USDA report, and I was, of course, all of us know the numbers, but I thought I must flag this. Look at the last 18 months or so. January 2020, soybean oil prices averaged $800 a ton. Come to April 2020, they dropped less than $600 a ton to $590. Then progress to September 2020, they are back at $800. And October 821, November $944, December 4 digits, $1,000 plus, and Feb, March, April, prices have been rising. I think there has been a relentless rise in prices. All of us know the reasons why prices have gone up, and I'm sure many of us also have a fairly good idea what is likely to happen in the second half of this year. But the point I want to make is that there is risk all the time, and therefore, as Ajay mentioned, you need to de-risk yourself. You need to hedge your risk and protect your margin, and don't wait. The market is not going to move the way you want it to move. The market has its own mood. The market has its own capricious attitude. I also want to draw the attention of all our participants, particularly the panelists, of course, too, as SEBI, a circular of November 2018, which very clearly says all listed entities need to disclose details of their hedging activities to mitigate commodity price risk in their corporate governance report. I'm sure many of them, almost all of them, must be following. I also want to refer to a Reserve Bank circular to all the banks, which says, and this is as far back May 2015, it was an advisory directive to corporates to hedge their commodity risk. So banks should be asking corporates which have exposure to commodities to hedge their commodity risk. Therefore, risk is everywhere. It makes it's a prudent way of business to de-risk the risk associated with business. And what better way than hedging is the point. Finally, when we talk about a futures contract, and I've been associated with the futures industry for more than 20 years, and I've in fact contributed to policy making in the late 90s, but that's another story. The point I want to make is what are the characteristic features of a good futures contract? I believe the salient features of a good futures contract are three. A futures contract must be sensible, a futures contract should be sensitive, and a futures contract should be sensuous. It should be sensible and rational so as to attract the attention and be useful to all those who use this contract. It must be sensitive to the needs of the users, and it should be designed so sensuously that it starts to attract a lot of participants. So sensible, sensitive, sensuous. That is the very nature of the futures contract. And I'm sure over the next 45 minutes or whatever, our elite panel is going to examine how well NSE's crude degummed soybean oil contract meets these characteristics. It's such a great delight for me to be a part of this. I am actually going to start with Amarendra Mishra. Okay, Amarendra, are you ready? Okay, I'm going to start asking him to talk about what do you think are the key ingredients of a good hedge policy? And because you represent a global company, an MNC, would you also share your experience of hedging both internationally and in India? First is to start talking about key ingredients of a good hedge policy for a corporate.
Hello, Chandrasekhar ji, and hello everyone. So, for me, the important thing is one of all the things that the risk management policy should cover. The key risk the organization of the business faces, and that has to be from the top-down approach where the management or the board decides and agree on the risk, and then at every level the risk is properly allocated to whom, to the people who are actually running the business. So in terms of the business where we are in, having the risk limits defined to the business heads, to the traders, to the people who are actually taking the position. So a clear definition that who does what and what type of risk an individual, a trader takes. So that is a very important thing. I think a risk management policy should have. Also, this policy needs to be regularly reviewed, because what you mentioned just now, that how the soybean oil prices have moved from $600 to $1,200. So having the same position at different price level entails a different type of risk. So the policy needs to be dynamic enough that it is aligned to the changing market condition. It also needs to be reviewed at different times at different levels, and then finally it has to be audited also, so that it's to check its implementation, that it is happening at the right times, at the right position. So those are the key ingredients I would say a risk management policy should have.
Very, very interesting. Obviously, the board first has to decide, and obviously it's a dynamic situation. You need to keep changing your position depending on how the market behaves and possibly your expectations of the behavior of the market. Can you also share, Amarendra, if your international experience in hedging or within India, either or both, in fact, if possible, for the benefit of the participants?
Yeah, sure. So, as you are aware, ADM has been in this business for more than 100 years. The company has evolved with the US markets, and CBOT as an exchange has been there for so many years. So our core belief has been that risk management forms a core agenda of our overall business, and at every level. When we are approaching our business, we have to be sensible enough to manage the risk in a way so that the company continues to run. I think, of course, being a key player in the agriculture industry, ADM has been participating on these exchanges and have been playing its role as a hedger, as a processor, as a supply chain participants, and have been like our experience have been fairly good, where we have developed the markets, where we have participated in the cash market, and also as a platform it provides a very transparent way of managing the risk and mitigating the risk. So overall experience have been very good. And talking about India also, We have been in this business through our joint venture partners as well as directly for more than 20 years. And we have borrowed from our international expertise as well as the thought philosophy of managing the risk. So we use Indian exchanges as well to manage the risk, and it has been fairly good.
Wonderful, wonderful. Thank you very much. I'll come back to you. There are one or two more questions, but let me finish the first round if you don't mind. I'm going to go to Sudhakar Desai. Sudhakar, of course, is the chairman of the IVPA, and I know over the last 2 or 3 years, he has actually turned around the association, built tremendous credibility amongst policymakers and other stakeholders and his members, and he's leading the charge as far as IVPA is concerned. And of course, his company Emami is very well known as an FMCG company, and they have large exposure to the edible oil market. Sudhakar, can you comment on the hedging ecosystem currently available in India, and what kind of corporate governance framework that we have? Any thoughts?
Yes, thanks, Chancheka. And let me start with current space only. I think the markets have gone up by, let's say, 80-90%. If you don't hedge now, when will you? So we are literally on the 10th floor. So the dangers are much higher than being on the first floor. So that is why it's very relevant and good to talk about all these issues. Many companies, big corporates have failed in this in the past. The companies which ran for 200 years also had collapsed just because they did not get the right risk philosophy. And many branded companies in US, I remember, one day suddenly realized that they are no longer in the branded business because the commodities fluctuated, like you said, 20, 30%. And then they realized, oh, there is a commodity issue today. So I covered these two topics. One is, let me start with 3 myths and 3 facts. Okay, a lot has been said, but hedging is very speculative. That is how many people perceive in India, which is actually counterintuitively wrong. Second is, India is a very big speculator. This is the second myth. But if you really see that a Dalian is trading, let's say, an Argentina crop already every day, and KLC, BMD is trading about 2 million tons every day. So compared to that, I think the speculative aspect or can you hear? Is it clear?
Yeah.
This is actually very
Perfect.
low.
Go ahead.
Yeah. So the third myth is that the commodity is very, very risky, unlike equities. That's why you don't find any mutual funds actively trading in commodities. But if you really see the last year's fantastic opportunity that coupled with the macro factors in the agriculture offered, I think it should be a good and attractive enough. So we have to come out of these 3 myths. And in the ecosystem, the 3 facts are that India is only generally long only strategy. In a rallying market, it's very easy. But in a falling and volatile market that we are seeing now, I think the role of hedging cannot be ruled out. And second fact is that the depth in the Indian markets is very, very low. Though we've been associated and following it for last, let's say, a decade or so, I think the volumes as a percentage of crop would make it very, very risky. And to use it as a hedge. Hedging price risk management is not only in the ecosystem, if I talk about, it's not only for the business, but it is for the government, it is for the management of the farmer prices, it is for handling the entire dealer value chain that are involved, it is for the big institutions who are the consumers of edible oil. Suddenly you realize that this entire ecosystem where everybody, including the aggregators, can actually participate will make it really the true ecosystem right now. Here, I just want to say, before I come to the corporate governance, the stability of the policies, the stability of the duty policies is very important, because one day if you say, I want to break this contract, I want to withdraw this, It can't work like this. I think it should be continuum, so that you give certain amount of stability to the market to build volumes. You are saying that the government and regulatory framework are there, but actually I believe that without all that, the business need has to be found, that hedging is a requirement. I mean, it's not necessary that the government or a regulator will tell you should do it because your equity can be at stake. I just take 3 more minutes to summarize my views on the corporate governance. Every company, at least in my experience, I've seen that you do hedging because you have to protect your margins, you have to protect your cash flows, you have to protect your brand margins. But more importantly than that, every company should know what business you are in, what is your sources of margin. Are you a branded company or a trading company, or are you running a brand based on the trading only? So once this objective is clear, you need three things. One is the risk framework, with the proper limits, proper risk committee, and reports and review. In an MNCs, for example, we are talking, even if you got let's say 3-4 lakh tons of oil, at least I am personally experienced it. If you cross 50 tons of limit, you will get you would get from the central head risk desk saying that you have no choice, you have to cut it in the next 1 hour, because otherwise it will become a huge objection. I think you need, that takes me to the second thing, that you need a discipline like this. And there are many ways, but VAR is a very important thing. That is a definition of how much can you lose in a particular day if your position go wrong. And it should be defined as a percentage of your equity or capital. So these risk appetites and this risk framework, this philosophy and culture is what makes the corporate governance. I want to just touch upon two issues that were spoken. Mr. KEDIA said that it's an insurance policy. I would just add it. It's a policy that you would take every day, and you change the term of the value of it every day, and you will go in and out every day, because at the end of the day, you want to make your cost of goods sold the lowest today in this competitive environment. That's what it is. The last point I want to say is that, as a caution in the ecosystem, however evolved it might look, I think my friend Amarendra spoke about Chicago. Recently, some of you, when you are trading it, you would know that there is something called a Texas hedge. That means you believe that the Chicago Board of Trade is a good hedge for let's say decade. Then there is a black swan event and everything goes haywire. Remember the K economy or a K philosophy when you are hedging, wherein your hedges can go as the upper curve of the K, and your risk that you are assuming actually will counterfeit. So it is an amazing field of hedging where you have to learn and relearn every day, managing this whole thing. Later, I would come about how we would visualize the future to be. Thank you.
Yeah, thanks, Sudhakar. Just before I go to Atul, I want to ask you, for you, when does price risk start? Or for any stakeholder in edible oil business, when does it start? Or in your case, when do you think it starts? And when do you think you recognize it and then start taking a hedge position?
Very good question. I like that, because for this, I need to know my business, and I need to know my consumer to start with before I decide when my risk starts. If you're in an import business, which I think most of the people are, the risk doesn't start. The risk of supply chain management starts much earlier. The risk of the price starts when you price your commodity. The risk stops when you sell your commodity. So suppose you have to be very clear about this entire value chain when you are dealing with the commodities, as to which risk are you managing. I mean, that's why I asked this question: which objective of the business are you defending? So, but simply put, if it is FX risk, for example, it will start the moment you convert your dollarized inventory into the rupee inventory. If you are dealing with commodity, it will start when you need to manage a hedge across the value chain of supply chain. Imagine if you are running a refinery. I think I give credit to our members and the industry of IVP and the entire industry, the whole industry is managing a huge risk of bringing from the origin, which means if you're running a refinery, you got to load a ship. There will be one ship which is afloat from Argentina. There will be one ship which is in the port. Then there is one ship unloaded for refining in your factory. So the real risk starts when you really start selling your goods to attain your targeted margin. I think in case we get confused about this formula, which we all did, which we call experience, which we call a lot of losses made in the past, is where we stand today. Thank you.
And thank you very much. I want to go to Atul Chaturvedi. Of course, he's been in this business, in this trade for very long years. And the SCA, all of us know, is an apex body, a pioneer in this vegetable oil sector. And many of the SCA members obviously have exposure to this market. Atul, that two questions I have. One is on as chairman or president of SCA. What would be your advice to your about price risk management? This is one. And second question is that how is the culture of hedging among stakeholders in the oil sector? First is your advice to your members about price risk management. Yeah.
Thank you, Shankar. I think our members really don't need any advice from me. I'm a novice in front of all those experts who are managing their business over the years. But having said that, it has been my fortune or misfortune, whatever you may like to call it, to be in a trade which has huge amounts of risk. And I've been in edible oil business for almost 40 odd years. And even now I'm handling a business as executive chairman of Renuka, where again, the risks are huge, whether the risks are currency, whether they are commodity, counterparty, God knows what all. So a trader's life is very, very tough, whether we like it or not. A trader's life is really tough. So he's got to manage so many things. And the only reason why over the years I would have probably come out relatively unscathed, I would have been scathed, definitely, is because we've managed to run a very strong and a robust risk management policy. Let me recount a small little incident. Way back in '97, when I joined Adani's, there were a whole lot of youngsters who were trading in various commodities like coffee and sesame and edible oils as well. We had started in a small way. Am I audible? Am I audible?
Yes.
Yes, sir.
Yes, sir.
Yeah.
Okay.
Yes.
Okay. Fair enough.
Voice is breaking, but I think it's still okay. What can we do? Yeah.
Okay. Fair enough. So when I joined the company, Gautam Bhai said, Atul, you must meet all the young traders whom we have hired over the last few years. And this is 1997. We had a bright youngster. The first question he asked in that interview, or so-called interview, and I was supposed to be their boss. Mr. Chaturvedi, what is going to be your job as far as Adani is concerned? So I thought for a moment and I said, my only job in Adani would be to see that your job remains intact, which simply means, again gone? Am I audible?
Continue.
Yes.
Continue, please.
So my only job is to protect your jobs, which means you have to have a very strong risk management policy in place, which incidentally at that point of time, we really did not have in the company. Obviously, the exposure on the commodities was also not all that great. So it's important from any corporate's viewpoint that you have a very, very, very strong risk management policy in place. if you want to have a sustainable model. If you're not having a sustainable model, if you're a fly-by-night operator, then it's your problem. How you do it is your problem. Let me recount another small story. This is probably sometime in the late 80s or early 90s. There was a very strong soya company. In fact, at that point of time, that company was being talked about as the future of the Indian edible oil industry. I'll not name the company. They got into trouble by not hedging their currency. And the end result was that that company probably is not even existing as of now. So this is the kind of, I still remember when they had imported something or they had taken an exposure as far as US dollars is concerned at around 33 or 34, and then suddenly the rupee depreciated to about 42, 43, and they were in for a massive, massive loss. And the company probably never came out of that. So that is something which is very, very important. One has to really look at it. Castor is another commodity which has seen very high mortality over the years. And I'm sure everyone here has some experience of that on the castor.
Yeah.
Whosoever in the castor trade wanted to become the leader, next year he was practically out of the business. 1 year you are a leader. So this tendency to be the poster boy of the commodity, as a trader, one needs to be aware of, and you should never try and be the poster boy of the commodity if you want to have a reasonably comfortable life. That's very, very important. In fact, over the years, I've seen, and this is something which I've seen very much among traders, instead of using the exchange as a hedging mechanism, they end up using exchange to make more money and doubling their money. With the result, what happens is they have a physical position with them, and then they also have a position on the futures as well. So you are long physical, you are long futures. So which means you are playing with fire, and if the market goes against you, then it's harakiri. And this is one tendency which I've seen a lot happening in Indian traders. And somebody who makes money on 1 or 2 days thinks he's the boss. He knows everything. But market is too big. Market is too big. You've got guys like Sudhakar operating on the other side who can take you to the cleaners. So all these things which it's important that one is aware of. So in the companies, a strong risk management policy needs to be in place in all corporates. And the other thing which is very important is that people generally, after making the policy, forget about monitoring it and reviewing it on a daily basis or a regular basis. So if you are not doing that, and the trader, if he has made some money, obviously making some money makes him a god, and he starts becoming reckless. And that is something which needs to be curbed, which means all these policies, risk management policies or whatever, have to be reviewed on a regular basis and monitored online. If you don't do that, you could be in trouble. The other thing which I think Sudhakar also mentioned and Amarendra also mentioned is that at each level there has to be a position limits. How we used to do it in our company is that a trader has this much of an open position which he can trade on. So if a person is trading 100 tons, he's allowed to have an open position of 10 tons. Because let me tell you, with back-to-back margins in our business is just not there. So one has to take some positions. So a trader is allowed an X position. His boss is allowed X plus. And if they have to go beyond that X plus, they have to go to the CEO of the company, which I was at that point of time. And if I was my position was also getting exceeded because there's some view on the markets and then it's got to go to the board and to the big man. So this position checking and all is very, very, very important. So this does not make a hero out of a trader or a zero out of him. So it's a much more sustainable
You're
model.
talking about a system of checks and balances and adequate internal control systems. I think extremely important. But Atul, based on what you had said a little earlier, about you recognize risk, you understand risk, and you're making out a case for risk management. I think it is time the SEA starts an awareness, education, and training program amongst all your members, particularly listed corporates for looking at the derivatives market as a tool for risk management. Don't you think so?
What you're, it's a very, very good suggestion. We certainly will lap it up, and this is also one of the reasons why at C we are joining hands with both BSC and NSC, even NCDX, to popularize their contracts and to popularize it. But yes, what you're saying is right. We need to have training sessions for the traders. Yes, we certainly will.
Perfect.
Your point very well taken. Your point very well taken.
Thank you very much. Thank you very much. I want to go to, if you don't mind, I want to go to Sandeep Bajoria. Sandeep, are you there? I'm not able to see you. Sandeep, are you there?
Yes, very much. Can you see me
very
now?
much. Okay, yeah, that's right. Okay.
Yeah.
Yes, I can see you now, my young Turk. Yes. Okay, obviously, that you're one of the biggest physical market brokers in this country, and who doesn't know you? Now, how do you manage your risk? You have seen it all in the last 15, 20 years. Obviously, you and I and all of us have seen it all, the kind of volatility that this market faces. So how do you de-risk your physical deals? What kind of advice you give to your customers and probably your principals? Any thoughts on that? And particularly with respect to soybean oil, if you have any special thoughts. Yeah.
First of all, thank you very much, NSC, and thank you, Chandra, for inviting me. And my great friends, Amrinder Mishra, Mr. Desai, Mr. Atul, have already spoken very well. I would just like to see, because we are handling as an intermediary, as a broker, more than 2 million tons of edible oil imports into the country. So we have clients based on every part of India. And, they buy in the lots of monthly 5,000, 10,000, 20,000 tons, 50,000 tons of oil. And that, like you see the prices which are there now, soybean oil prices started the year at about $750 and they went up to $1,500. And now that $1,500 has come down to $1,300. So while you make money, you start, booking your profits quite early, and maybe any $50-$100 gain, you will just get out of the thing, But when it falls like a stone, and you are absolutely in a quagmire at that point of time. This is the soybean oil situation. You see sunflower oil. Sunflower oil started the year again with $760 and went up to $1,750. And from $1,750, it is now it is $1,350. So the rise was the biggest which was seen in last 10, 12 years. And the fall also in last 1 month has been very, very steep. And this fall has caught people unawares, and definitely the price risk management is a very big challenge at this point of time right now. Because there is while hedging is necessary, compulsory, no doubt about it, everybody said that, and every company should have policy that maybe 60% to 70 to 80, 90, 95, 98% or 100%, they should keep hedge positions. So the board has to devise this policy, and the boss of the company has to devise this policy and make the position like this. But many of the physical players in India, they do like this. While they maybe some exchanges, some risk hedge they do, but most of them they will say, okay, my monthly production is 30,000 tons. So 15 days production, that is 15,000 tons, I will keep open. And remaining, I will keep it hedged. So they have that kind of policy. Somebody has 1 week policy, 1 week of the production, somebody has 15 days, somebody has 30 days, that kind of thing. So that is also a good effective policy. because market can go up, market can go down. You are very constant with it that 15 days production, that is 15,000 tons, you will keep open and rest you will keep hedged. So in that also, it's like a self-insurance you're buying, and that also works. And another thing is, while we, my friend Pradeep Chaudhary would be there listening to this, and I was discussing with him. He's a veteran in this field. What Pradeep ji has said actually was that if you don't play within exchanges or one exchange, second exchange, third exchange. I'll give you an example. Like if you have a position in MDEX, if you buy CPO, it is better that your CPO, you hedge it in the CPO FOB. Or if you have a position in MDEX, you handle it that way. But if you try to handle the MDEX position through MCX in India, which is a duty paid futures, and MDEX is before duty, then you have a lot of mismatch. And many times while the price can move in tandem 60 to 80% time, but with the government policies, government intervention, your hedge may not be the perfect hedge. So Pradeep ji was always saying that don't play around one oil to another oil, don't play around between one exchange to another exchange, whatever commodity you are doing. Try, and if you buy soybean oil, it's better that you want to hedge it, you hedge the FOB Argentina. Because if you try to, like, okay, you buy soybean oil and you want to hedge it on the Chicago Board of Trade, some guys who did that. So as Sudhakar was saying, the Black Swan event, Amrinder was saying, so like this time, Chicago is like an island by itself. The US soybean oil market is an island by itself. It has gone like from 55 cent to 73, 74 cent without a stop. And Argentina premium on the other side, which we are running at plus 300, yesterday was about minus 1650. This is unheard of premium. I think, Chandra, you also must not have heard these premiums, this kind of numbers. So if, let's say, if somebody had MJJ, May, June, July, he had booked premiums alone at plus 250. And today, when the actual time is coming to price everything out, then it is minus 1650. So minus 1650 plus 250 is 1900 points. 1900 points, it's something around $450 or $475. So you are in that kind of a loss. So you have to be very, I believe these derivatives are trying to play with the Chicago and the premiums also has been a very risky at this point of time. So that's why most advisable is that if you buy big quantity of soybean oil, more than what you want to have, then it's better for a big player. If you're buying 20,000 to 30,000 tons per month, it's better to hedge it on FOB Argentina. That is the most safest way you can hedge it. And I would say also to the buyers that when they buy, don't play around with, especially in years like this, Chicago and premiums. You are not going to be pundit to come on the right side of the market. More than 80% times you will come on the wrong side. And then you see how people got battered by paying $475 extra. Like some of the soybean contracts today in India, which while soybean price was highest was 1,500 and now it is 1,325, their contracts will be $2,000. Can you imagine that? So it's important to hedge and very compulsory to hedge, but where to hedge, how to hedge, what open position to take, in which exchange to take is very, very important. And I would totally agree with Pradeep ji when he said that if you are buying much quantity of crude palm oil, then you are hedging either partly MDEX and partly FOB Indonesia. And if you're buying huge quantity of soybean oil, then your hedge would be FOB Argentina. So this is how you play, you are much safer. Otherwise, while you have a hedge policy, you try to hedge, but your hedges can go haywire. So this is one thing. And as far as the NSC, which is introducing the Digam soybean oil contract, I want to say it's a very good effort they are doing. We need this kind of a contract because we are importing 3.3 million tons of Digam soybean oil. And while MCX CPO contract is very strong and very nicely used contract, there is a strong room to use Digam soybean oil contract. But somehow the participants, major participants, and all of us have to put extra effort to make it work because we need this contract to be alive so that we can hedge it. And so I think all of us should make extra effort, and I believe this contract can be successful. So this is what I wanted to say. Thank you, Chandra.
Thank you. Thank you very much. I think it's again what Ajay said, chicken and egg situation, when all the market participants, those stakeholders with exposure to the physical market come onto the NSE platform, start trading this contract, obviously volumes will go up, liquidity will improve, etc. I think basically I would in fact think that this contract, cash settled contract, is a far superior contract, primarily because the globally almost all contracts are cash settled. Less than 1% of the traded volumes actually end up in delivery. Okay, and therefore the intention of a commodity futures exchange has not been delivery at all. Delivery is incidental. In India, it is taking place for certain legal reasons, but otherwise, a cash settled contract is an ideal hedge instrument for those with exposure to the physical market. Anyway, thank you very much, Sandeep. I want to go to Ravindra Rao with so much of experience and knowledge. Ravindra, what do you think? What about oil prices? Do they actually respect the technical indicators? Do they move based on technical indicators? What have you seen? And what would be your thoughts on the NSE's crude soybean oil contract? First, the relationship between what the charts show and the actual movement in the marketplace. Ravindra Rao, are you with me?
Yeah, I'm audible.
Yeah. Now, yes.
Now, yes. Thank you, Chandrasekhar ji. Thank you, NSE, for inviting me on this group discussion on this elite panel on risk management in edible oil. I think Chandrasekhar ji, as you have rightly put, I think the price is one of the important factor, and price, I would say, price is the king, because whether you're hedging 100% or whether you're hedging partly, as Sandeep ji said, still I think everybody is concerned about price. And if we talk about there is always a debate about fundamental and technical analysis, and I think fundamentals is something which we talk of long term. Like, fundamental doesn't change every day. But if you look at the pandemic situation that has arisen in 2020 start, and till now we are struggling with it. And as the panelists mentioned, the prices of soya oil has skyrocketed once it came down to multi-year lows, and then it has moved up very sharply in last 1 year or 1 year 3 months or so. So I think in such scenario, technical analysis plays a very important role. I would like to show something on this front. Just hold on. My screen is visible.
Yeah. Go ahead, please.
Okay. Now this is the price chart of seaboard soybean oil futures. This is the continuous chart, and if you look at the price moves, like, nobody expected that the price will move from around say 25, 26 cents to around 73, 74 levels, which it is currently trading at. Now you can see how the indicators indicate that the prices move first, and then the fundamental pointers come in. Now, if you look at the pandemic when it started in around May 2020, you can see everything was negative. All the commodity prices were coming down, but it was the charts that indicated a support which was around, I would say, around 10-year long support, where the prices were trading at, and from there we had seen a strong up move. Now, this was the first indication that the prices are going to go up, and then slowly and steadily it has moved up, and then this triangle break has indicated that it is going to go up very sharply. And in fact, as per the triangle break, the target comes to around 84 cents. But I think now it is slightly trading near the 2008-2009 highs of around 70 to 60. So you can see that there were bullish factors once the prices started moving higher, but when the prices were trading at lower levels, you can see that there were no bullish factors. So it was the technical charts that indicated that the prices might go higher. And the current situation, if you see, the current situation says that the prices are very highly overbought. And there is a great chance that seaboard soya oil might slightly correct and it might come down to around 60 cents odd. So now this is soya bean for you. Now soya bean, if you see, I was actually talking to a corporate way back in November 2020, December 2020, and I was telling him that it is trading in a very stiff triangle and anytime it might move higher. And I told him that NCDX soybean might come up till say 7,000 odd levels, which is the triangle target. So this is what happened. Like once it moved out, there was a slight bearish news in terms of bird flu, but then you can see how it has moved higher. Now this is a clear indication that whatever may be the fundamentals, the technical indicators will indicate you it is a leading indicator, and then the fundamentals follow. And you can see how it has achieved the targets of the triangle. Now what happens is this gives a hedger or a trader a very good indication of where the price is going to go. And as per that, what they can do is they can take a directional view, and on the basis of that, they can combine fundamentals and technicals and take a clear picture. Now this is CPO. If you see CPO also, it was trading in a broad channel since I would say since
Your slide is not moving.
You can't see the chart, CPO?
Still on soya.
For me, I can see it. I don't know. So anyways, what I meant to say is that if you take technical as well as fundamental into consideration, I think it can be a huge support for the traders, for the hedgers who are either looking for say 100% hedge. If somebody is looking for 100% hedge, then I think price is not a concern. But if somebody is looking for a part hedge, then I think they go for a price check, and then they take a decision. So I think technical analysis plays an important role, whether it is agro commodities or international commodities, whether it is hedging or trading or anything else.
Absolutely.
I think it
interesting. There is an echo, but
there is nothing which I can do.
Thanks. I think technical analysis is extremely important. It's simply that there is a pattern in everybody's life. And if there is a pattern in the market, and the charts tell you what the pattern is and what is likely to happen. So I think that's fine. But one question, Ravindra, I'm sure you must have studied NSA's contract. And do you think the NSA's contract seeks to meet the needs of the market? Has the market felt a need for this contract, and will it fulfill the needs of market participants?
Of course, yes. I think if you look at the correlation like Ajay showed, with CPO the correlation is around 96%, and with soya oil it is just the refining charges that has to be added to refine soya oil. The best part is that the degummed soya oil expiry and CPO expiry is the same. So I had done, like in algo trading, what we do is we do a strategy called mean reversion, wherein we take two commodities, and on the basis of that we see whether it is a mean reverting spread is possible or not. So in case of NCDX soya oil and CPO, the problem was that NCDX gets expired on the 20th of every month, whereas CPO gets expired on the end of the month. But in case of degummed soya oil and CPO, I think both expires on the at the end of the month. So that gives it a very good opportunity for traders to bet on the spreads between CPO Digam's oil. Now it has given a breakout. The spread is around 290 odd, and it actually gives a clear advantage. And second is there was no contract to bet on the soya oil, Digam soya oil spread, because normally the mean is 35, the spread mean is 35. But now that whenever the spread goes to 60 or 65, you can always sell the commodity which is at premium and buy the commodity which is at a discount. So I think it is a very good contract from different from strategizing different strategies also, and also from the hedging perspective.
Yeah, and I'm sure you will agree when I say that this is a great contract, particularly for financial investors or institutional investors who may be wary of taking delivery or giving delivery, because this is a cash settled contract. I think financial investors and institutional investors will feel absolutely comfortable trading this. Is what I think. I want to come to Ajay because he does a lot of research, and of course he made a presentation which is very interesting. I am not now able to recall every slide of what Ajay you presented, but can you talk something about the correlation between the NSE's contract and other contracts available in the Indian market, and with, of course, international contracts? Any relationships? Can you throw some light on that?
See, thank you, sir. If you see the correlation, we have already run a correlation for last 3 years and found that Digam oil is having a good correlation with the range of let's say 86% to 100% in refined soy oil as a 100%, sunflower oil as a 86%. So almost we have taken a time period of, let's say, 3 months, 6 months, 1 year. We have found it's a good correlation with oil, every oil, let it be castor oil or sunflower oil or rice bran oil. So I think, see, most of the time when we talk some corporate, they told that our oil has been not listed on future exchange, have had to hedge. We don't know. We don't want to go to international. In domestic market, we don't have anything. So there is an option. We can say it's a synthetic hedge, or we can say it's a mirror contract when it's a correlation of 90 plus. So where we can have a value neutral position and we can hedge our risk.
Thank you. I think that brings me to that point, that enormous amount of awareness, training, education is required to tell all the stakeholders and investors about the benefit of this contract. I think we are actually racing against time, but I'm not going to conclude this in a hurry. I'm going to take one last round with all the panelists. I'm going to start again with Amarendra Mishra. Amarendra, any concluding thoughts, final comments that you would want to make? You made your point very effectively. I'm sure you've heard all other speakers. Any concluding remarks that you have?
Yeah, so I think one key thing which I want to look in this futures contract is that also, like we talk about participants taking more active participation in the futures contract. Also, I think they need to develop as a benchmark which the policymakers and especially the government can use to develop the policy for the agriculture sector and commodity sector in India. Many times I feel that the futures market is being looked at as a, like, you don't like the message, so you shoot the messenger. So futures market should not be treated as that. And this is the difference which I see. Like if you talk about US, no, the US government does not say that you should close CBOT. I mean the markets are there, have been for long. So I think these markets have to be developed and treated in a way that they give us an indication that how the market should function, are functioning, or what the market is giving us the message, and then it acts as a message for the participants and the policymakers. Thank you,
Amarendra. Sudhakar, any parting comments from your side? Any advice to NSE? Let me put it bluntly. Yeah. Sudhakar, are you there?
Yes, please. Thank you. I just unmuted myself. Number one is that in terms of education and telling everybody to hedge, I feel that the market will be the best educator, because when it teaches you, you lose quite a good amount of money. You have to put money on the table. So it should teach you next time to be ready. Number two.
Sorry, one sec, pardon. I'm not able to contain myself. After the market has pauperized me and I've become a garib man. I mean,
Yes, many people should
I
relate
think,
to
I think
that.
we need to, as somebody said, sorry for my interruption, experience is like a comb that you get after you become bald. Okay, so that experience is dangerous. I think we need to create awareness in advance. But I respect what you're saying. There will be a shakeout in the market if people don't realize. I agree with you.
Yes,
Please
number
go
one.
ahead,
So,
sorry.
so number one, the market is the greatest humbler and the real
Humbler,
educator.
yes.
No amount of
Indeed.
classroom and technical session and elaborate education on how it is going to be useful will not help unless the market teaches you that lesson. Okay, number one. Number two, speculators are a must for all these products. Number three, you have to assume risk and manage it every day. It's not something you just hedge and forget. So it is a day-to-day thing. And the moment you see the volatility, start judging it as a percentage of your margin. Then you realize that your P&L, which when you risk adjusted to the returns, you would realize what risk are you taking to earn your margin. Simply put, if you are making, let's say 2 rupees, 3, 4, 5 rupees, let me be optimistic, for 3 rupees a liter in selling your oil, and if your daily volatility is 5 rupees, that means there is something wrong. And number four, if you are feeling very comfortable and good and making money, start hedging. And the next point is, the concluding point you just said is that finding a right correlation is a life's experience. You need to have a right product. I'm not too sure by just having one product which services the need of refineries like Digam oil is good enough. I would personally would love to see one day the Indian exchanges to be so active where you can do a commodity, you can do a basket of. How does Chicago operate? There are people in Chicago. You can hedge your crushing margin. In Chicago, you can do your corn bean ratios. You can protect your plantation margin. In India, also today, rapeseed farmers, fantastic opportunity to sell a put option and just be clear that they will not lose money if the market falls. Otherwise, what happens in the industry in Indian farming cycle? During the sowing time, it's all fantastic. During harvest time, they sell at the lowest possible price. Then rest of the year, they become the consumer of the country, bearing the brunt of the inflation of the high prices. Are they really getting today soybean farmers? Are they really getting 70,000, 72,000 rupees? No way. Most of them have sold it in November. So I do believe that this daily in and out things, putting a lot of conditionalities, allowing foreign investors to invest in the hedge, but then you tie their hands to say you do only long only, you can't sell it, but you can only buy it. If you start putting all these conditionalities, I think the Indian exchanges will remain what they are. The day all the Indian players, the percentage of the hedge in the Indian country, because the risk emanates in India for the players here. So instead of what did Dalian do? They did not try to hedge. They developed commodities. That's how I would like to see Indian situation. Policy, last but not the least, there is a great need to make a stable commodity duty policy, balancing between MSP and the consumer price and what the government wants to achieve, and make it very transparent, so that you're not compelled to become a large speculator every day. We got a business to run. So the stability of policies, stability in the not creating huge volatility due to tariffs, rumors. Then only the companies and the Indian players can invest in brands, invest in the high quality, invest in R&D, invest in distribution channel, invest in start thinking of consumer. I think to do all that, the ecosystem should have a stable, transparent policy. You can't be coming every day to see, what is going to happen to the policy today. So as IVPA, on behalf of IVPA, We are continue to make these constructive suggestions on behalf of the industry to make it stable so that the business can improve the profitability, can run smoothly, can hedge, and can be safe. Thank you.
Very well. Very well, Sudhakar. Thank you very much. As someone who works very closely with the market regulator, I can tell you that many of those niche products that you're talking about, what is available on seaboard, they'll all be coming gradually into our market. SEBI is very keen to deepen and widen the market. That is why now they have allowed mutual funds. They have allowed alternate investment fund category 3. PMS is allowed. Options trading is allowed. Index is allowed. I mean, we are gradually, rather cautiously moving forward, but definitely moving forward. There's no doubt at all. I think it's a matter of time. Exchanges also have to research and identify the needs of the market participant. Thank you very much. I'll go to Atul for his concluding comments and closing comments, and if any thought, any advice, any guidance for NSE.
No, I really don't have any guidance for NSE, but initially I think when KEDIA was speaking, he said if you're not hedging, you are actually speculating.
That's right, correct.
So my fundamental question is speculation bad? If you are going to be ignoring the speculators and only concentrating on the hedgers, mind you, your exchange is never going to run. Your exchange will never run because you will not have the volumes and you will not have the depth. So it is important you educate the hedgers as well, and also speculators because whether we like it or not, speculators are a necessary evil if we consider them as evil. I don't consider them as evil. And any and every trader who's trading commodity is also a speculator to the extent of maybe 10, 15, 20%. Whatever is his open position, he's actually speculating on that. So you just cannot ignore the speculator. And if you continue to downgrade or denigrate these speculators, I'm afraid it will be very difficult for the contract to actually take off big time. So this is my only suggestion.
Point very well taken. Extremely important. It is like this. The statement actually is hedging is not speculation. Not hedging is speculation. We are not talking about speculators. Speculators are an integral part of this market. Hedgers on the one side, speculators on the market. On the other side, they create liquidity. But if you don't hedge, you're actually speculating on the market. That was the point.
Chandra, the biggest problem of all our contracts on the exchanges is lack of liquidity.
That's right. Correct.
So it is important that Sudhakar was talking about the farmers hedging. I think we're talking in the air. To expect a farmer with a 1 acre farm or a 2 acre farm, it's not something logical or practical. You need to consolidate, whether by way of FPOs or whether by way of whatever, so that the farmers are also educated. Once the farmers are educated, they start hedging on the exchange, or just like what the Argentinians or the Brazilians do, they sell on the Chicago and hedge their risk like in sugar as well. So it's important that we educate that sector of the society as well.
Absolutely. Point taken. That is why, one second, that is why we have farmer producer companies, and I work with many of them and educate them about risk management. Yes, Sudhakar, sorry.
What I meant to say, Chandrasekhar and Atul, is you see, you got this big farmers, then you got aggregators, you got farmer producer organizations, you got commission agents. So they all can aggregate the risk of the farmers, which they do today actually, and then on their behalf they can actually use I agree that the farmer, with a small holding cannot, but somewhere that is the job of the intermediaries to provide such a platform. I think a little innovation can make some of these things happen. Somebody else will. He may not, but somebody else, the warehouse receipts guys, can act as I'll take my goods, but I will hedge it on your behalf, and I will pay you based on these trust receipts. when actually hedging is completed when you
Correct.
choose. So
Very
I think
true, very
I think these things are more needed to evolve with the futuristic vision.
true.
Yeah.
Very true. The role of
Other thing which
FPO.
I thought the other thing, Chandra, which I thought I'll put across is
Sure. Please.
because of the lack of liquidity in the contracts,
Yeah.
whether it be castor, whether it be
Whatever.
soybean or whatever,
Whatever.
there is generally a tendency of cartelization and then rigging the contract. Whether we call the exchanges as messengers. That's a very good word. But at times it works the other way around. And mind you, having dealt with a lot of policymakers and bureaucrats over the years, they always fear this. So if you have massive liquidity in the system, it's very difficult to. I remember telling somebody who was very active as far as castor contract is concerned. I said, it's easy to take it up, but for exit, you could be in serious trouble because exiting is not that easy. So that is the reason why you have such high mortality rate in castor speculators. So it's important that concentration should be on developing the liquidity and don't ignore the speculators. Hedges will automatically come. Speculators are also a very important part of the ecosystem.
Point very well taken. Without the speculator, there's no market, really speaking. I completely agree. Then I'm now coming to Sandeep. Are you there? Sandeep, any passing comments from your side? And Sandeep, or has he left?
He's busy making money.
Making money, yeah. I'm happy for him. But let him also use NSE contract to make money.
Not making money, managing the risk.
Any passing comments?
I said I was managing the risk.
Come. He's already put through a deal in the last 3 minutes. Yeah, come on.
Yeah. So now I would say principally that Indian exchanges like NSE, MCX, and CDEX are by far doing some good work, and we all participate in those exchanges, and we need to participate more. Percentage wise, I would say if you are a large player, 50% of your exposure you can take care hedging in Indian exchanges, and 50% you need to do in overseas exchanges, depending on from which place you buy, and exactly what I said earlier. So this is what I would say if you are handling at least 30,000 tons a month. So that is what it is. So portion of that will be self-insurance, that you keep 10,000 tons to play around with all around the year. Other 10,000 ton you do on Indian exchanges, and the last 10,000 ton you do on whether you buy palm on the FOB Indonesia or you buy soya on FOB Argentina. That would be the right combination for anybody.
Okay.
Secondly, I would say the exchanges in India, sometimes, this is NSE is just starting, but I have this complaint many times. The day holiday is there, the foreign exchanges are completely closed. And Indian exchange start from 5 p.m. to 9 p.m. again. I think it's a very troublesome thing. Holiday should be in holiday. We should learn something from Chinese when they have 7 days holidays. So that is more important. And thirdly, the daily fluctuation limit which exchanges made from 4 to 6%. We saw in last 1 month, there were a lot of objections to it. And I think there should have been a wider consultation before taking such a drastic step. Already the prices were double than before. And on that 4 to 6%, that means one side movement of soya contract will be 60 to 70 rupees and other side 60 to 70 rupees. So I think exchanges need to be more talking to the stakeholders and then make the policy. Thank you very much.
Right, thanks. Ravindra Rao, in 1 minute, in less than 1 minute, some concluding remark. And same for Ajay. Yeah. We need to conclude.
Yes. Chandrasekharji, I think I would agree with Atulji because what he said, that liquidity is very important. I think that is the key for the contract to succeed. And after that, I think we should also think of other products like options. I think options is something which all the exchanges should look at, because we need different kind of product to strategize different strategies. So I think that is what is expected from the exchanges, and that is what we are looking at. That's it.
Thank you. Ajay?
First of all, I think voice is ego. Ravindra, your mic is, I think, open.
Yeah.
Okay. So first of all, Atul ji, मेरा जो presentation था, that is not against of speculator. Speculator is definitely required है system में. Just जो corporates hedging नहीं कर रहे हैं, वो एक speculation की तरफ जा रहे हैं. मेरा message ये है. Secondly, market के अंदर जिस ढंग से liquidity की बात है, तो chicken egg वाली situation है. जब तक हम लोग थोड़ा-थोड़ा करके सबकी ओर से corporate हो, let it be speculator, let it be trader, let it be small traders, सब लोग मिलकर अगर इसमें स्टार्ट करेंगे तो ये एक अच्छा वॉल्यूम जनरेटिंग एक्सचेंज प्लेटफॉर्म बनेगा. अदरवाइज हम लोग दूर से देखकर यही बात कर रहे हैं कि मार्केट में लिक्विडिटी नहीं है. तो आई थिंक इट्स अ नीड ऑफ आवर के एवरीवन शुड पार्टिसिपेट, स्मॉल देयर पार्टिसिपेशन, then only we can see a good liquidity on exchanges.
All right, thank you very much. I think I just want to conclude this by saying 2 or 3 things. First is that in my own view, the NSE's decom soybean oil contract actually seeks to fulfill a felt need in the marketplace. This is important, and primarily for those with exposure to soybean oil. It is a cash settled contract, which is actually an advantage because there are no hassles of delivery, and it's very convenience, basically ease of doing business. Principally, commodity markets, futures markets are not intended for delivery, but we have a delivery window in our country for various products. But otherwise, it's a pure hedging platform, and that's the global experience primarily. The NSE contract, in my view, provides a great opportunity for institutional investors and financial investors. And therefore, there is a lot more awareness, education, and training and promotion that is required amongst all the stakeholders. And finally, as I said in the beginning, a contract must have 3 characteristics: sensible, sensitive, sensuous. Based at least on all that we have heard, I think, I assume that NSA's contract probably substantially meets all the three criteria of being sensible to the needs of the market participant, sensitive to the needs of the market participant, and sensuous enough to attract their participation and use of the contract. With this, I want to thank each one of the panelists. Thank you very much. I think it's been a great experience. I think we've been discussing for more than an hour. We have really overshot our time, but it was quite interesting, and a lot of eye-opening comments, a lot of insightful comments from each one of the panelists. Good luck. God bless you all. Stay safe. I now hand the mic over back to NSE.
Thank you so much. Thank you so much, DC sir. It was really wonderful having you, all of you here. So, Honorable Ravi sir, respected analysts, invited guests, ladies and gentlemen, it's my privilege to have been asked to propose a vote of thanks on this occasion. On behalf of Team NSE, let me extend a very hearty vote of thanks to Chandrasekhar sir for moderating this panel so well and gracing this webinar with his expert comments. A big thank you to Mr. Ajay KEDIA for his efforts to explain and describe how hedging is of utmost importance for your business and how the NSE CDSO contract has become the ideal product of hedging. We are very grateful and would like to acknowledge our gratitude to our distinguished panelists as well, Mr. Sandeep Bajoria, Mr. Amrendra Mishra, Mr. Sudhakar Desai, Mr. Atul Chaturvedi, and Mr. Ravindra Rao to share their valuable comments and opinions this afternoon in this discussion. On a side note, Mr. Atul Chaturvedi, I hope we have lived up to your expectations and promise of having an enormous participant number. I am pleased to inform you, sir, that we have touched close to 300 participants this afternoon in this webinar. Well, I cannot thank everyone enough for the time spared from their respective busy schedules, especially in this pandemic, to prepare themselves for this wonderful knowledge spreading session beyond their comfort zones. Well, ladies and gentlemen, an event like this cannot happen overnight. The wheels start rolling weeks ago. It requires lots of planning and a bird's eye for details. Well, ladies and gentlemen, I once again would want to state that we are sincerely obliged to all speakers to grace this platform. And dear guest, we thank you for being such wonderful listeners this evening. And it has been a great pleasure having you all. Thank you very much. Stay safe. We end the webinar now.